What's up, guys? I'm leaving Bali tomorrow, but I wanted to squeeze this episode in before I left because we are at a super critical juncture in the stock markets, and I wanted to get the message out to you folks before the week begins. Now, what's going on is that the stock market has been rising and rising and rising, just like it did back in 2007 when we experienced the last great recession.
Apple's up more than 6% right now. Google about 3%, but Dell, Intel, Research Motion, and Microsoft are all to the upside. Look how strong.
Did not disappoint. 400 points higher. Yes, indeed. The market's 4 higher last 30 minutes of trading as volatility once again rules the day.
Most of the techs this morning, if not all of them, have just exploded.
And back then, if you recall, the Fed had also been raising interest rates consistently. And that's what they've been doing now as well. And it was in 2007, September 18, when Bernanke, back then, the Fed chairman, lowered the interest rates after raising it for a while. And guess what happened in 2024? On September 18th, down to the same day, the current Fed chairman, Jerome Powell, did the same thing and lowered interest rates by 50 basis points. Now, you can call this coincidence and timing and whatnot, but I actually believe that this is a very similar pattern. If you look at the stock price market action, where back in 07 it had risen, then there was like this pretty big correction that then led to even new all-time highs, which then led to another significant correction, and then another squeak of an all-time high before it all unraveled. And we today are literally at that juncture. We had a big run up, and we also had a big correction. Then we had another big run up, creating new all-time highs. Then another serious correction most recently. And then here we are. We just squeaked out a new all-time high right around the time when the Fed pivoted and started cutting interest rates. Now, this week is going to be critical, because if the market doesn't do a peak and dive, meaning like it makes the all-time high and continues up, and it has to do that, then that is a signal that no, we're not replaying 2007 here, that there's probably going to be potential more upside, and that we have to look into getting exposure into the long part of the market to take advantage of the upside as it continues to go up for some time.
And believe me, Kevin, the only problem you're going to have is that you didn't buy more. Sound fair enough?
Shit, my wife might divorce me, but yeah, let's do it.
However, if this week turns into a big red bar, meaning prices do a pretty significant decline this week, and we create a new all-time high last week, but there's no follow-through after the similarities of what we saw in 07 in the rise of interest rates, Fed pivot, and the cut of interest rates and the price action, then that's a signal that we are at risk here of a 2007 type of market decline going into the end of the year, with some volatility up and down, but generally going down, and into 2025 being a not so good year, just like 2008 was, culminating in the end of 2008, and for this case, it would be the end of 2025, pretty devastating. Back then it felt like almost a 58% drop in the markets in 07, 08. We could be experiencing something like that, possibly even worse this time. And so we have to take a look at what is going on with the stock market this week. It's going to tell us, and I think this is the moment, right? It's either make or break here. And that's why I wanted to get the word out to you, because if we ignore this and we just treat it like any other week, we're going to completely miss the signal. And these types of signals, I don't do these financial stock market type of episodes all the time, but I do it when there's a key moment, a pivotal moment that's upon us. And this is one of those times. So I just want to get the word out. Take a look at it. Look, if we do have a big down week, that is a clear signal to start liquidating and taking assets and your net worth out of the stock market and start preparing for a potential decline that could be as big as 50 or plus more percent going into the end of next year. And we have to just, people say like this time it's different, and the fundamentals are not the same as it was before, and that's true. I agree. Like the fundamentals are never exactly the same, and there's that saying that history doesn't repeat but it rhymes, and all these metaphors sound good, but ultimately what matters is the price action. The price is a reflection, ultimately, not of fundamentals, but of general psychology, right? human psychology, and that never changes. And so like the fundamentals, of course they play a factor, but we'll only know after the price action occurs, and then we look back like Monday Football quarterbacking and explain away through fundamentals why the price acted the way it did in the past. But using fundamentals going forward is very tricky because the markets don't act based on fundamentals. It can become extremely exuberant and just go bonkers like it did with .com and with AI and all this stuff, or it could go extremely negative like during the crashes that we experienced like in '87 and 2000 and even the COVID crash in 2022, right? So the fundamentals play a role, but the market actions and the price action doesn't necessarily tether to it, right? And they can be detached for a long time. And so what I like to do is actually look at just the price action, and barring like significant shocks, like news events, like some kind of like 9/11 event or some Fed, interest rate policy that's a shocker. Yes, that'll change the price action and create like volatility for that moment. But generally speaking, it's the price action that dictates, and then we use fundamentals to explain away what happened in the past to do Monday morning quarterbacking. And that's the way, that's why you have all these pundits on I don't know what the future is. Nobody really knows, right? But what we can do is look at the price action barring some shock news event. And that'll tell us and give us a signal to the psychology, which is really what I'm interested in, on what's driving the market. Because that's really what drives the market. It's the psychology, not the fundamentals. Like the fundamentals play a role into the psychology, but the psychology dictates the price action. And so the fundamentals is an indirect determinant of the price action ultimately in the market. Now, having said that, we can't ignore the fundamentals completely. And so some of the key fundamental components that I'm looking at for right now is, number one, what's going on in China. If you don't know what's going on in China, China is in some serious trouble right now. They are in a deflationary period, right? Like as in prices actually going down. And essentially what happened was, look, after COVID hit, there was a huge injection by the Western governments into people's pockets, right, to spend money and to not have the economy collapse. And they really hit the nuclear afterburners on that. So people started spending like crazy, right, if you recall. And what that did was create artificial demand, basically, like not real demand because it's not sustainable, but like this huge spike in artificial demand comes something like, injecting yourself with a drug, right? Whoa, you get this huge reaction immediately.
Do you know why you're here? I'm here for the same reason you is, man. I want some crack.
That's what happened with consumer demand. And so the Chinese manufacturing companies mistook that as real demand and started ramping up production, right? And guess what? A couple of years after the drug wore off and the demand isn't as strong anymore because the drug is, gone, right? There's a glut now. There's a glut of supply in the global markets. We're still interconnected for parts and supply chain management. So these Chinese companies now are facing serious price deflationary issues because there's way too much supply now compared to the demand, because the demand is not there anymore, right? The initial, injection shot of, wanting to buy stuff is gone. And even the US is now putting political pressure in China saying, hey, don't flood the markets with supply. But in fact, it was the US that actually, juiced up the demand for them to ramp up the supply. So China is in a situation right now where they're in a deflationary scare / potential spiral. That's one thing. And if they go into a spiral, that is gonna not just, in fact, if you think that's only going to be contained within China, you're not living in a globalized world. Trust me, it will. The other thing that I'm looking at is the yen carry trade. Remember that a couple of months ago that happened in the stock market? That's what caused that correction, that pretty steep drop. Well, the yen carry trade is something that was created over decades, right, of many financial institutions leveraging the exchange rate, differences to their advantage. That doesn't get unwound in 1 week. That it doesn't work that way. Decades of spaghetti twining up to take advantage of something doesn't get pulled apart in 1 week like that. So there's still stuff going on there that I'm pretty certain we're going to see more of in the future. The other thing that's also going on is the commercial real estate bubble. I mean, that is seriously a bubble. Keep on hearing about news of, business structures, buildings, commercial buildings selling for some crazily small amount, and the amount of basically interest rate adjustments where they're going to have to pay again is coming up, right? This next year is going to be a huge, just like the subprime mortgage, there's going to be a lot of payments at higher interest rates, which is part of the reason why the Fed's trying to cut rates so that that shock won't be so huge to all the institutions that have bought and paid for all these commercial real estate properties. So those are some of the, fundamentals that I'm looking at that could be like shock events. And then there's like the generic ones, such as the U.S. consumer being tapped out, as you can see with the all-time high in credit delinquencies and late payments, so that the demand is, like I said, like you inject, okay, but there's a crash and like the U.S. consumer is really tapped out if you look at the data, along with the unemployment numbers, which have been juiced up because of the elections this year, and all these downward revisions have been doing like month after month at record downward revisions, is pretty telling of what's going on. So those are some other components of the slowdown that we're looking at. Some people try to believe that there's no recession coming, and the Fed's going to engineer a soft landing. And these people, right? Number one, the Fed has never successfully engineered a soft landing since it was created, except for this one time out of like almost a century's worth of existence. Even that one is debatable. Every other time they've failed, right? And we've had hard landings and recessions. And there's never been a time where you've accumulated so much in a debt-driven economy where you juice up the interest rate like they did to fight inflation, which they caused. The Fed's like the firefighter that's an arsonist. Like, yeah, sure, they came to save the day, but you know what? They lit the fire. They did that, and so they had to raise the interest rate, and now they cut up. Look, that's going to cause a shock to the system that's been living off of zero rate interests, or ZIRP, for decades, right? For decades. And all of a sudden they had to do this shock raise. That's going to have reverberations that continue, and it won't be over, I don't think, until probably end of next year. So having said that, let's take a look. I'm not saying that we're going to crash this week by any means, but I'm saying we're going to know this week based on what the market does, whether or not this is it or not, right? And if it is it, clearly what I've said specifically is what I'm going to do is I'm going to continue lightening my exposure to the stock markets, because who wants to be in a stock market that's going to collapse like 50+%, especially if your leverage or on margin even higher, right? And I'm going to actually increase my short positions and play the market out. But I wouldn't recommend this is not investment advice. Go seek a registered investment advisor for that. But for myself, that's what I'm going to do. And so kind of interesting to see what happens. I'll see you in the next episode back in Singapore. Peace.